Hi students. For the benefit of CA intermediate students who is going to write coming examination, we are going to discuss about one common topic which is relevant for Group 2 Financial Management as well as Auditing. For us, auditing discussion, we are having auditing legend, VIKAS OSWAL sir. Now we are going to share some information which is more relevant for coming examinations.
Yes.
Shall we?
Yes, sir. Yes, sir. Let us start.
Now, sir is going to talk about standards on auditing. Before that, I am going to discuss about ratio analysis, how it is going to have the link between ratio analysis and standards on auditing. That only we are going to discuss, so that it's a common topic, more useful for your examination. With respect to ratio analysis, what is called a ratio? Why we need a ratio? What are the importance of the ratio? For example, Ram got 250 marks and Krishna got 210 marks. If you are going to ask who is best, we can say 250 mark is the best one, Ram is the best person. But you know very well, the 250 marks is for both the group and 210 mark is for single group. Then obviously we'll tell what 210 is the best one. Therefore, we can't in the position to compare whether 250 is best or 200 is best, 210 is best. Out of what, that is important. Same thing applicable for in the industry also. Mere by way of absolute amount of profit, which company is best, we can't in the position to say. We can be in the position to analyze the profit is out of how much sales. The percentage of profit is the criteria to measure which company is the best one. So the percentage of profit is called ratio. The ratio is nothing but comparison. Comparing one element with another element is called ratio. For that purpose, how to compute ratio, it plays a vital role. Suppose we are saying turnover of the company, first year 100 lakhs, second year 110 lakhs, third year 125 lakhs, and next year 600 lakhs. Then some sort of doubt will be there in the financial statement. How suddenly sales has increased to what 600 lakhs. If you are going to analyze, we can be the person to identify. Sales means everything may not form part of sales. That particular year, they might have sold some land and building. That is also forming part of sales because everything sales, they pass the entry. So the accountant might have passed the entry. Sales means normal sales, day-to-day transaction also sales. And land and building sales also form part of the P&L account. But as a chartered accountant student, you know very well, revenue item is different, capital item is different. Everything will not form part of that particular place. For that purpose, ratio analysis plays a vital role. If there is a deviation, if there is an abnormal difference, we can be the person to identify and we can be the person to analyze whether it's a mistake or fraud or what. For that, ratio analysis plays a vital role. It's a useful tool for us to identify the mistake easily. For example, current ratio, you know. What is the formula for current ratio? Current asset divided by current liability. What is the prudent current ratio? 2:1. So, what is the significance of 2:1? Current asset divided by current liability is equal to 2:1 means 2 represent current asset, 1 represent current liability. So, each and every 1 rupee of liability, company is having 2 rupees worth of assets. Therefore, company is in the safer zone. Same manner, quick ratio, you know. Quick asset divided by current liability. Prudent quick ratio is 1:1. Suppose one particular company, current ratio 2:1 and quick ratio comes to 0.25:1. Then, based on that, we can analyze the difference between current asset and quick asset is called stock. Therefore, company is having more stock. Companies, if they are having more stock, then we have to analyze whether slow moving, non-moving stocks are more or what. That we have to analyze. We can't the position to pile up the stock. We have to convert the stock and we have to sell. Then only we can be the position to see the cash. For that, ratio analysis is going to help like anything. Similarly, inventory coverage ratio, you know. Interest coverage ratio, you know. So many ratios are there. With respect to interest coverage ratio, what is the formula for interest coverage ratio? EBIT divided by interest. higher the interest coverage ratio is best or lower the interest coverage ratio is best. Once in intermediate examination they asked. Interest coverage ratio, you know, EBIT. Suppose numerator EBIT comes to 100 lakhs. Divided by interest comes to 50 lakhs. Therefore, interest coverage ratio for the company comes to 2. 100 divided by 50. Next company, 100 lakhs EBIT, earnings before interest and tax. Whereas interest comes to 10 lakhs. Therefore, interest coverage ratio comes to 10 times. So, first company 2, second company 10 times. Which one is best? The second company is the best one. Why? 2 times how it is arise? EBIT 100 lakhs, whereas interest 50 lakhs means out of earning, 50% of the earnings they are spending only for the purpose of interest. Therefore, where is the take home profit then? So, we have to analyze the interest coverage ratio. More means better. Subject to trading on equity also we have to verify. Similarly, gross profit ratio 20%, whereas net profit ratio only 3%. Then the difference between gross profit and net profit is purely because of what? Huge gross profit ratio, whereas very less net profit ratio. Therefore, why it has reduced? It's purely because of companies having more operating expenses, so that we have to give the advice to the company. Try to minimize the expenses to the extent possible. Otherwise, majority of the profit going to loot by way of expenditure itself. In general, with respect to ratio analysis, commonly doubt among the CA students or confusing terminologies will be there in the examination. Even study material also, students used to get the confusion. One is called return on asset. Another one is return on investment. Next one is return on equity and return on capital employed. All the terminology looks similar but different meaning, so that you should be very careful. Return on investment is called general terminology. The return on investment is applicable for all returns, including return on equity, return on capital employed, return on asset, everything we can call it as the return on investment. Return out of investment. I am going to invest the money, how much I am getting return. That's a general terminology. Depending upon the circumstance, the return on investment going to vary. The formula may going to vary. But other things are all specific terminology. Return on equity represent what? How much equity shareholders going to get the benefit. That percentage is called return on equity. Formula for return on equity is earnings available to equity shareholders divided by equity share capital into 100 is equal to return on equity. Next one is return on capital employed. Return on capital employed, it's nothing but equity plus other funds also, own fund and borrowed fund, total fund. In that circumstance, the formula is EBIT divided by capital employed into 100. Totally how much I have invested, for that how much income out of the business is called return on capital employed. Return on asset, I am investing the money in asset, how much the profit I am going to get return out of asset. That is called return on asset. Therefore, profit divided by total asset into 100. Therefore, return on investment, return on asset, return on capital employed and return on equity, all the terminology should be proper. Another confusing terminology is capital block, capital employed, proprietary fund, net worth. In this, they are going to get the confusion. Capital employed represent what? Total capital. How much the procurement of fund by way of own fund and borrowed fund. Total is called capital employed. In other words, total liability minus current liability balance is equal to capital employed. Capital employed consists of equity share capital, preference share capital, long-term loans and debenture. Net worth represent what? Share capital plus reserves and surplus is called net worth. The shareholders fund is called net worth. Shareholders fund, share capital plus reserves and surplus. Share capital represent equity share capital plus reserves and surplus. And preference share capital also if I am going to add, then it is called proprietary fund. Capital block represent what? Capital block and capital employed both are one and same. Once they ask 7 mark question, they given the terminology in the ratio analysis, capital block. Many students, because what is capital block they don't know, they left the question itself. So these are all the terminology should be proper. Now ratio analysis in the financial management, we are discussing, we are solving the problem only in purely in finance nature. But same thing is there in the auditing paper also. The common things if you are going to study properly, they have a better grip. Terminology only little going to vary. Here we are seeing the financial aspect, but the ratio analysis is going to help both finance as well as non-financial aspect. Ratio analysis is a comparison. Similar comparison is there in costing paper. Where in costing paper, what and all it's available. Budgetary control on topic is there. Standard costing on topic is there. That is also what comparison. So the standard costing, budgetary control, ratio analysis, these are all what? Wonderful tool for controlling the management or controlling the financial statement. Those controlled as a package is called standards on auditing in auditing paper. In standards on auditing, 520 talks about analytical procedure. So what is called the analytical procedure? How the ratio analysis or trend analysis or budgetary control or standard costing, how it is going to help, in what manner we have to study in analytical procedure, that sir will discuss. In addition to that, whether it is going to help for finance and non-financial aspect, what is called the non-financial aspect, that is also we supposed to learn from standards on auditing. And 500 standards on auditing, 500 audit evidence, it seems, right sir? Okay. In audit evidence, they said what? Analytical review. What is called the analytical review and what is called analytical procedure in 520, both are one and same or not. These are all the doubts among the students. For that, we are having better person for our soldier, sir, going to help how to read the standards on auditing. Please, sir.
Thank you, Hari. It was very nicely explained by you, Hari, about ratio. See, SA 520 is a standard on auditing which talks about analytical procedure. First of all, we have to understand what is standard on auditing. See, standards on auditing are the principles followed by an auditor as to how he should conduct an independent audit. See, we auditor, we need to follow a guideline. And standards on auditing are those guidelines which teach us how an audit should be conducted. Now, one thing, that this standard 520, it tells about how intelligent you are. Hari, tell me whether you are intelligent or whether I am intelligent.
Obviously, you only, sir.
No. See, I may be knowledgeable. Intelligence and knowledge is two different things. But I think you are more intelligent than me. So, one thing is that this standard talks about how intelligent you are. And the generation you who is watching this video, you guys are more intelligent than us. We may be, I and Hari may be knowledgeable because we have spent more number of years on the Mother Earth. Knowledge and intelligence is different. There are some auditors in India who will just look into the financial statement and tell you where all we have misstatements. So this is a very, very important standard for your IPC syllabus where minimum 5 marks question will come in the examination. Analytical procedures refers to evaluation of financial information through analysis of financial and non-financial information. As an auditor, we need to not only analyze financial information but also non-financial information. Take example, there is a company. In this company, there are several employees working in the company. So every month there are 10,000 employees for which the company is paying some salary. Now what happens? There is a correlation between the number of employees who are working in the company and what is the outflow which is happening to an employee. Month number 1, the outflow may be say, for example, say 1 crore. Month number 2, the outflow may be 1.1 crore. Month number 3, the outflow may be say 90 lakhs. But suddenly in the month number 4, there's an outflow of say 3 crores. So this is an abnormal variation where we are linking the financial information and non-financial information. That is the number of employees vis-a-vis the salary paid. In analytical procedures, an auditor assumes there is a relationship among the data. It exists, it continues to exist unless conditioned to the contrary. What happens is that, for example, there is a link between say credit sale and the customer account. There's always a link between purchases and the supplier account. There's a link between depreciation and fixed assets. So there are items in financial statement where we have to link. See, best example for analyzing anybody is mother. I mean, nobody can analyze as mother is. Because see, for example, when you go home and you're feeling tired, the day has been very bad, the mother will tell you, no, today you're feeling very tired, or you're not good, or you're feeling sad. What happened in the college, what happened in the class? So she will tell you, she will read your mind like anything. Many times what has happened, Hari, I want to eat my favorite masala dosa, and that day morning mother would have made the same thing. So is there a virtual umbilical cord between mother and child? We never know. That is one thing. Now in analytical procedures, once we analyze the financial information, we need to investigate if there is an abnormal variation. Why there is an abnormal variation, and accordingly we need to apply detailed audit procedures. Analytical procedures can be applied at various stages. One is at the planning stage, one is at the testing stage, and one is at the completion stage. When you apply analytical procedures at the beginning of the audit, it is called as, my dear soldiers, risk assessment procedure, and it is applied in the planning stage at the beginning of the audit. Sometimes we also call it as analytical review. Analytical procedures and analytical review, there is no difference as such. Interchangeably they are used. Hari raised a very, very valid point that, sir, what is the difference? As such, there is no difference. My dear soldiers, one more thing. When we apply analytical procedures at the planning stage, what we are trying to do? We are trying to identify critical areas. On which area I should focus more. Say for example, simple method is what? Comparing the current year sales with the prior period sales. That's the best example. So suppose, say, if there is an abnormal variation in the sales, what I will do? Chalo, I have to check sales. Example, say last year sale was 1 crore. This year sale is 25 crore. It's abnormally changing. So I need to investigate why there is an abnormal variation. And second thing, my dear soldiers, we also apply analytical procedures at the testing stage and at the completion stage. When you apply analytical procedure at the testing stage and a completion stage, we call it as a substantive analytical procedure. Okay, so it's all depend upon timing. When you apply analytical procedure at the beginning, you call it as a risk assessment procedure, where you find out where all risks are there, because ultimately our audit is what? It is all risk-based audit. Risk means problem. Wherever more problem, apply more audit procedures. Wherever less problem, apply less audit procedure. That's how it is. Now, substantive analytical procedures, basically it is applied at the testing stage and at the completion stage of audit. So they may ask you a question. What are the factors to be considered while applying substantive analytical procedures? This may be a question in the examination. So what is the answer you will write? First of all, suitability of analytical procedures for assertion on the account balances, class of transaction and disclosure by considering the test of details and risk of material misstatement. What does it mean? First of all, suitability of analytical procedure. Whether analytical procedure is suitable or not. See, I'll tell you, in my experience of audit, I always find analytical procedure being more suitable for P&L item compared to balance sheet item. Example, I can compare last year's sale with this year's sale. I can compare last year's expense with this year's expense and try to analyze why there is a variation. But can you compare a last year cash with this year cash? Cash is as on balance sheet date. So, analytical procedure is not so suitable for balance sheet item. Generally, that is the thing. So, you have to check that suitability of analytical procedures on account balances, class of transaction, disclosure. What is the account balance? Account balance is nothing but the balance sheet item. And class of transaction is nothing but the profit and loss item. Disclosure means the notes to accounts. So first of all, what do we check? Suitability of analytical procedure on an assertion by considering account balance, class of transaction and disclosure, and by considering the test of details and risk of material misstatement. As I told you, our audits are risk-based audit. So wherever there is more risk, we need to focus more as an auditor. Further, next thing what we check is that we evaluate the reliability of data which is used for analytical procedure, from where the amount is derived, actually where the expected amount or the expected ratio is derived. So we have to consider the reliability of the data. See, generally what happens, if the input data is correct, then only output data will be correct. So there may be a chances that the data may not be reliable. So for that purpose, my dear soldiers, we have to check what the sources of information, the comparability of the information, controls in the preparation of information, and nature of information. This may be an important question in the examination, that what are the various aspects related to reliability of data. I repeat, the sources of information, the comparability of information, controls in the preparation of information, and the nature of information. Further, my dear soldiers, we also need to understand that what is the expected amount or what is the expected ratio. See, as an auditor, I need to check that, okay, what is the expected profit a company can make, or what is an expected output generated by an industry. So if this is an amount of raw material, what is an output that will be generated? So that expectation is built. So every year, for example, GP ratio is 15%, 15%, 15%. On one particular year, it is say 22% or 25%. Now that is way too abnormal. So we build an expectation. And finally, my dear soldiers, we need to determine the difference between the expected amount and the recorded amount, and the expected amount and the recorded ratio. So you may come across certain ratio. So what is the expected and what is the recorded amount? You need to know the difference. Determine the difference. If the difference is abnormal, then investigate. See, for example, you expected a ratio of 15%. It turned out to be a higher ratio, say 25%. Then try to determine why there is so much variation. Determine and investigate the fluctuations and the inconsistent relationship. Ultimately, analytical procedure revolves around two most important things. One, comparing the current year information with the prior period or the budgeted information, as Hari sir highlighted very importantly that how budgets are important. And second thing is that also considering the relationship between items. As I told you, sale will be linked with the customer account. That is how it is. Further, my dear soldiers, as an auditor, we need to investigate the undue fluctuations, why there are so much fluctuations, what is the reason, and try to find out the reasons out of it. There are four types of analytical procedures. One is the ratio analysis, as Hari sir beautifully explained what is ratio, I need not tell. And then trend analysis, where you compare the current year information with the prior period information. You also have reasonableness testing, as I was telling you about how we link input raw material to output. Is output reasonable or not for a given level of input? And also you have structural modeling, where we use statistical methods, probability theory to arrive at the conclusion. Ultimately, analytical procedure is a very powerful tool for conducting an audit. So it was really nice, Hari. I mean, you came out with a wonderful idea actually. I think you are very intelligent.
Thank you so much, sir. Thank you. Hope this video is very useful for you. Okay, please share this video to all. Thank you so much. Thank you for your time.
Thank you, sir.